Welcome back to the Microlearning Institute. In this tutorial we look at Mondo. It's question number 4 from the May 2013 AIA Paper 13 exam, and it looks at a practical application of IFRS 8 operating segments. Firstly, we're asked to consider the allocation of some common costs. As these costs are reviewed by the chief operating decision maker, they must be included in segment data. So when we look at the profit figures per the question for the three companies Chudo, Weedon and Thursdo, which are respectively 26 million of a loss, 176 million of a profit and 100 million of a profit, we can now allocate the head office costs on the basis of turnover. Now, the total head office cost is $17 million, and the respective turnover is given to us in the question at 380 million, 510 million and 840 million. It's important to note that the turnover figures here include both the external and internal turnover. So therefore the 17 million allocated in these proportions to Chudo, Wendon and Thurso gives us an adjustment to profit of as shown on this sheet. Next up, we look at the property management cost, and again the property management cost must be allocated to the individual companies' segments on the basis of the age of the properties. So again, we're told in the question that the overall cost of property management is $30 million, and the respective age of the properties in each of the individual segments is 5 years, 10 years and 15 years respectively. And again, here we can see the adjustment to the quoted profit figures in each of the segments with respect to property management costs. Next up, we look at the post-employment benefit. And again, this is allocated based on the number of employees who are eligible. Now, no employee is eligible in Chudo, and 200 and 300 respectively employees are eligible in Weedon and Thurso. And the post-employment benefit cost is $20 million. And again, here we see that cost being allocated in proportion to the employees who are eligible. The loan interest, again, is allocated based on turnover, and we see a $20 million loan with an interest figure of 6%, again allocated in the proportion of turnover. And here are the costs associated with that allocated to each individual segment. So the updated figures are as shown on this spreadsheet. Now we must determine which of these segments are segments that must be reported under IFRS 8. So IFRS 8 gives us a number of criteria which determine whether a segment is a reportable segment or not. Some of these criteria are qualitative criteria. That is, things like, does this segment earn revenue and does the segment incur costs? Is this segment data reviewed by the chief operating decision maker? And is financial data available for this segment? Other criteria are what are called quantitative criteria. And here we look at some 10% rules. And IFRS 8 says that if the revenue, assets or profit of a segment exceed 10% of the overall revenue, assets or profit of the overall organization, then that segment is a reportable segment. Now let's look at each of the criteria. Each of the segments earn revenue and incur costs. Similarly, each of the segments are reviewed by the chief operating decision maker, and yes, financial information is available for all the segments. So all of the qualitative criteria are met. Now immediately we can say that each segment is reportable, but just to complete the exercise, we can look at the quantitative criteria. For each segment, the revenue earned is 10% or more of the overall segment of the organization. And similarly, for each segment, the assets, well, for segments Weedon and Thurso, the assets represent 10% or more of the overall assets of the organization. You will note that for Chudo, with assets of only $510 million, these do not represent more than 10% of the overall assets. So Chudo does not meet the quantitative asset criteria. However, of course, notwithstanding that, the fact that judo meets any of the other criteria means that it already is classified as a reportable segment. Now finally, the final quantitative criteria is the profit criteria, and again let's look at a working for that. And the profit criteria is met if the profit is the higher of the 10% of all companies that are reporting a profit. Now if we look at our updated profit schedule, we'll see the two companies reporting a profit of 152.7 and 64.4 respectively, and 10% of that is 21.7. Now it also the threshold is the higher of either that number, 21.7, or 10% of all the companies reporting a loss. Now again, if we look back at our updated profit schedule, we'll see that one company or one segment is reporting a loss of 35.3 and 10% of that is 3.5. Now, so therefore, the profit threshold for IFRS 8 from this exercise is 21.7. So therefore, any segment that's reporting a profit or a loss whose absolute value is greater than 21.7 is deemed to be a reportable segment under the 10% profit threshold criteria. Now if we look at the profit figures for judo, Weedon and Thurso, we'll see that in all cases the profit figure, the absolute value of the profit figure exceeds 21.7. So again, we can see that all of the segments meet the 10% profit quantitative criteria. Next up, we can discuss some of the geographical area considerations with regard to IFRS 8. And IFRS 8 requires revenue from external customers to be split into domicile and foreign. Also, IFRS 8 requires non-current assets, excluding deferred tax, financial assets or post-employment benefits, to be split into domicile and foreign. And with regard to major customers, IFRS 8 requires disclosure of reliance on major customers. So again, we would need to disclose 200 million to the former owners of judo, and again we disclose this fact, we discuss the amount in question, and we discuss what segment it applies to. Thank you very much for watching this short tutorial dealing with AIA's Paper 13 May 2013 question called Mondo.